And we're on.
Good morning, all. This is the April 21st meeting of the Development and Finance Committee of the Housing Opportunities Commission of Montgomery County. And we welcome all of you, those of you who are here and those of you who are watching from another location. I am Jackie Simon, the chair, and to my left is Rick Nelson. And to my right is Jeffrey Merkowitz, who is the commission's chair pro tem, if I remember correctly. The first item on our agenda is the approval of our committee minutes of March 23. Is there a motion to approve them as circulated?
So moved. Second.
It's been moved and seconded. All in favor indicate by saying aye.
Aye.
Aye. The minutes are approved as they were circulated. The next item on our agenda is the approval of new participating lenders for the single family mortgage purchase program and the primary residential mortgage. Ms. Andrews, would you be kind enough to kick off this item?
Absolutely. Thank you. And good morning, Madam Chair, commissioners, members of the public, and the HOC team. This first matter is a matter that comes to this committee often as we consider how to expand our reach and provide our loan program to many individuals interested in purchasing homes in our county. I will turn it over to our mortgage finance team led by Monty Stafford and Paulette Dudley, our program specialist, to provide more details related to this request.
Before you begin, may I congratulate you and the staff on your presentation to the Realtors Association this week. You really hit it out of the park, the ball that is out of the park. And there were a number of people who participated, and I've had several phone calls about, we didn't know these programs existed. How can we people? So it clearly made an impact, and I thank you very much for the effort that went into getting that word out in that medium. When it was in their territory, I guess they reacted to it differently than they might have otherwise. So it worked out very well, and I appreciate it. Thanks.
Thank you, Commissioner Simon, and what you're sharing with me, I will channel directly to Paulette and her staff, because they deserve 110% of the effort. Paulette did first thing after share with great exuberance how receptive people were. So we appreciate that.
Yeah, it was great.
Yes.
So
thank you,
Director Andrews. Good morning, Commission. For the record, my name is Monty Stanford, Director of Mortgage Finance. At this point, I'd like to turn it over to Paulette Dudley to discuss the approval of a new participating lender for the single family mortgage program. Paulette?
yes, good morning. A beautiful morning for sure. Commissioner Simon, thank you so much. I did get your email, and we were excited to do it, and GCAR was excited to give us that opportunity. And I've expressed to them that if anything else comes up, then we want to be participating in that as well. So thank you so much. And we have gotten some responses back from realtors also.
Great.
Okay, excuse for the record, my name is Paulette Dudley, Program Specialist for the Single Family Home Ownership Program under the Mortgage Finance Division. I'm coming to you once again for an approval for participating lenders for the Single Family Mortgage Purchase Program. As we're getting more exposure, more lenders are wanting to participate in our program, which will expand, of course, all that we do. And once again, this is that we have, all of our approved, the commission approves the continuous participation of lenders from program to program and ongoing new lenders. These lenders that are approved for our program, they have the exposure to our single family mortgage products, as well as the revolving closing cost assistance and any other special closing cost programs that we have out there in conjunction with using our first mortgage program. So all approved and participating lenders are advised that continued participation requires mortgage loan production. So just because your name's on the list does not mean that you can produce any loans if you have not over the past 12 months. At that point, HOC, will ask them to get more training, and then they will be put back into the program. Currently, we have 25 active lenders in the program, and they are subject to retraining, as I've said. They must be approved by our master servicer, which is US Bank. And I'm bringing to you today the approval for Volume and Primary Residential Mortgage, which is PRMI. And there will be a correction that'll be made on the title because the title is not correct in the agenda itself. So the minimum qualifications for lender participation are that the lender is not a mortgage broker and can close loans in the company's name. The lender is an FHA approved seller servicer and has FHA direct endorsement. Also, the lender is a Freddie or Fannie seller servicer originating our conventional products. New lenders are required to be approved by US Bank. And in addition, they must again have origination experience in the single family tax exempt bond programs. Next. The approved lenders, again, they do receive training with US Bank, with the HOC staff, and also with our lock-in desk, which is eHousing Plus. The lender's approval will apply to the 1979 Single Family Revenue Bond Program, the 2009 Single Family Housing Revenue Bonds, and the 2019 Program Revenue Bond Resolutions. The following companies have applied to participate, and they have met the minimum requirements and criteria for selection stated above, and that's Volume Mortgage and Primary Residential Mortgage, Inc. So Volume Mortgage was established in 2017, and they're headquartered in Fairfax, Virginia. They are, however, licensed in 13 states. Volume has two main offices in Fairfax and Annapolis, but has a smaller branch in Rockville, Maryland. And all applicants are welcome to apply online, as well as if they are unable to make it into a physical office. Volume Mortgage is a home mortgage lender created to elevate the mortgage experience for clients. This new company that we have on board has come as a result of the closing of, if you all remember, Apex Home Mortgage became Celebrity Home Mortgage, and Celebrity Home Mortgage in 2023 was no longer producing any loans, so that the various production teams that belong to these mortgage companies, the Y team, which was producing with Apex, has partnered with Volume to continue to help families achieve their goal of home ownership. And so the Y team, which was a part of Apex / Celebrity Mortgage, approached Volume in order to have them to continue to participate in our HOC program. They are located in Rockville, Maryland, and they're looking forward to continue their relationship with us and using our single family mortgage purchase program. I have included, because of us increasing our income limits, et cetera, that statistically in 2022, Volume originated 41 loans for Montgomery County properties. So many of that probably would have come to us, but the sales price that ran, the average sales price of those 41 loans was $430,000, and with a loan amount of $17 million. With the sales price of $17 million, they had the average loan amount of $382,000 with a total loan amount of about $15.7 million. The income range for those 41 loans was the average was $111,000, and the range was $51,000 to $199,000. So you see that still falls within our goal of just getting out to everybody about our program and everyone using the program from the 51,000 to the 199,000 income limit. Bloom currently participates in the Maryland CDA program, the DC Housing Finance Agency, and the Virginia Housing Development Authority. Moving on. Primary residential mortgage, also known as PRMI. They're a national lender that has business since 1997 and is currently licensed in 49 states. Their corporate offices are located in Salt Lake City. That is their corporate office. Their goal is to provide all borrowers with the best possible financing options available in today's market. PRMI is currently approved with 51 housing finance agencies. Not all are, of course, approved HFA tax exempt bonds, as they vary from state to state. But they currently are a CDA participating lender and have been designated as a gold level performer for CDA, originating over 30 loans or more per quarter. Currently, PMI has 19 Maryland licensed branch offices and are FHA approved, et cetera, as I've said before. Statistically, for PRMI, in 2022, they originated 29 loans in Montgomery County with an average sales price of $418,000. Total of those sales was about $12 million. The average loan amount was $352,000 with a total loan amount of about $10 million. The income average was $117,000, and their range was from $59,000 to $190,000 for their income range. Again, falling within the increases that we have had as well. It is our goal that the DFIN and the Finance Committee will recommend to the commission that the commission approve balloon mortgage and also primary mortgage residential for participation in our program. Thank you. And if there are any questions.
Are there any questions?
I would move support of the staff recommendation.
I also approve. I would like to tell the staff that the way you presented this information on the statistical makes me feel much better about the broadened list, and particularly that they clearly are producing for our primary audience. And so I appreciate your doing that. It also makes me feel better about raising the income limits. And it reduces my anxiety about people that are not based in Montgomery County per se. So thank you for providing that information. I will no longer resist some of these issues or on the basis of those issues. It's been moved and seconded. Would all in favor please indicate by saying aye.
Aye.
Aye. The staff's recommendation is approved, and thank you so much for the additional information.
Thank you, Commissioner Simon.
Thank you.
Our next item is approval of permanent financing plan of selected scattered sites.
Thank you, Madam Chair. This matter will be presented by our mortgage finance team in regards to the financing plan for a portion of our scattered sites. As we know, scattered sites are a valuable resource for our clients. They are our larger home units across the county, allows for individuals to have access to various parts of the county, and it really allows for families to have a place to call home. Again, however, our scattered sites are also some of our most challenging properties to maintain because they are scattered in terms of maintenance and upkeep and outreach to our clients. And so it's something we're always having to balance. They also happen to be one of the most difficult assets in terms of how to finance them because they're scattered and because they're in different financial vehicles, and there's so many complex factors that play a role. We are in the process of doing a comprehensive analysis in terms of the capital improvements needed on certain scattered sites and what our disposition strategy would be, if any, across the board. But at the same time, had to embark upon a quest to determine our financial strategy for a number of our scattered sites that were on a line of credit with PNC that we needed to address before August. And so today you'll hear about that financial plan, and in the future you'll hear more about the holistic approach to our scattered sites. I will turn it over to Monty Stanford and our mortgage finance team to provide more details.
Thank you, Executive Director Andrews. Again, for the record, my name is Monty Stanford, Director of Mortgage Finance.
You might have to speak up a little bit and probably bring the mic.
That's better. Thank you.
Thank you. Good morning again, Commissioners. I echo everything Executive Director Andrews has said about the scattered sites portfolio. It has presented some very interesting and unique challenges, not just in terms of the underwriting, but across the agency in terms of us developing a holistic view about moving this portfolio forward. It is perpetual in nature. It is constantly changing, constantly evolving, the demographics, the environments around it, and even the markets that we operate in. So I appreciate today the presentation that my colleague Jeremiah Battle is about to make, to share with you our findings and recommendations for moving forward with the scattered sites portfolio. Jeremiah?
Good morning, Commissioners. For the record, Jeremiah Battle, Senior Multifamily Underwriter. So as shown, by way of background, there are 1,796 units in the total portfolio. Portfolio was accumulated over decades through various methods, including right of first refusal and RAD Section 18 dispositions. Currently, approximately $51.7 million is outstanding of senior debt, 50.2 of which matures in August 2023, and those are the PNC facilities. The ownership types vary among the portfolio, but can ultimately be broken down into HOC directs, limited partnerships, and development corporations. As alluded to, there are a number of regulatory constraints on the units. The majority are encumbered by a HUD-RAD agreement and various other covenants, regulatory agreements, or land use agreements that restrict the ability to dispose of units and increase rents. Significant capital needs among the portfolio. So despite the regulatory constraints, increased maintenance costs and deteriorating physical conditions are a major concern. Some properties have been partially renovated in the past 10 to 15 years. Others have not. So we're going through a comprehensive due diligence process internally to determine the capital needs over the next 3 to 5 years. They provide significant public purpose, as alluded to. The majority of the households serve between 30 and 80% AMI. Many of the residents have been living in these properties, in these units for a long time and have no intentions on leaving. And we're proud of that. And the majority are townhomes, so they provide affordable housing to not just individuals, but to families. Next slide, please. So the previously approved financing plan goes back almost 6 years. In December of 2017, DPC 1 and 2 specifically was approved for a 5-year facility from PNC Bank. To qualify for the facility, HOC was the conduit issuer to lend the proceeds for a $52 million loan. That was set to mature in December of last year. The commission approved an extension of the PNC facility for VPC 1 and 2 to August of this year. And along with that extension, the commission asked for a comprehensive plan for the entire scattered sites portfolio. And that's where we are today, talking about the financing of what we're calling the select scattered sites. So of the 1796 total, we initially looked at 1,038 that were considered to support the financing. So within the 1796, 758 of the units we discovered have no debt and don't contribute significant NOI among the portfolio. Therefore, they weren't considered for financing, which came down to the 1,038. Within that 1,038, 230 of the units were not recommended, given economic vacancy of greater than 18%. In addition to the fact that they only provided 2% of the existing debt and 7% of the NOI. This is as of March 2023. So that brought us back down to the resulting 808 units, which we're calling the core scattered sites and are recommending for financing.
Jeremiah, can I just interrupt? Sorry, quick question. Why is it that units with no debt don't contribute to net operating income? Is that?
It's not that they, so it was two scenarios. It was how much debt is outstanding and or are they contributing significant NOI? So it wasn't that the ones that don't have debt also don't contribute NOI, but it was those two scenarios that we looked at to size the permanent financing.
So should that be 758 units have no debt or do not contribute to?
The typo, it could say and or do not contribute.
Okay.
How much NOI do they contribute?
So if you look at kind of skipping ahead here, essentially they contribute 7% outside of what we're considering. So the ones that we are considering contribute 93% of the NOI.
And
I guess I'm on that point, and I'm going to raise the question later. If they have no debt, why is their NOI not significant? I mean, I'm not sure I quite understand it.
That was sort of my question. Like,
I mean,
it would seem like they would contribute significantly
Yeah.
to
I don't
NOI.
understand it.
Yes, so the size of the portfolio, the ones that we are considering, the VPC 1 and 2 make up 679 units by
Right.
themselves of the 808. The other portfolios, the other entities are much smaller. So relative to the amount of financing that we're looking to leverage, it's not zero NOI, but we're just looking at the financials as of March that came straight from Yardi, and they proved to be negligible numbers. I don't have those numbers in front of me right now, but the March financials, show the most significant NOI coming from the ones that we're recommending for financing.
And the economic vacancy rate, is this planned vacancy for renovation, or is there another reason for that being that high?
We believe most of the economic vacancy is a result of arrearages. And that is a component of our underwriting that we are going to drill down on. We, as Jeremiah alluded to, have noted several variations, pre-COVID, COVID, post-COVID, that we will have to adjust for in our underwriting prior to coming before.
I mean, that's what I was wondering. Like, so is that a hangover from the pandemic? Those arrearages?
We're assuming so, but we would like
You
to
haven't-
provide a
okay.
more precise analysis of that before we can say yes, it is.
Got it.
But we assume it is because it's been the case in every other
Right.
property agency.
I'm sorry, go ahead.
I guess, and again, on that point, when I take VPC 1, for example, the history of VPC1 is every time we talk about it, there's always a significant vacancy, and that's pre-COVID. If you look at the data you have in the later chart, it shows, I think, FY19. I think that, at least from what we've been told before, they traditionally have a significant issue in terms of vacancy. What causes those vacancies is maybe up for debate. And I'm not convinced that it's mostly related to COVID and the arrearages in COVID. And I guess what bothers me about this whole thing, and maybe I'm just not getting it, is how do we go about refinancing these? We don't know the answer in terms of vacancies. We don't know the answer in terms of the need for renovation, how much money. I mean, if we refinance and we find out we've got some renovation needs, how are we going to pay for it? One would think that if you're going to go into a refinance for 30 or 35 years, that you would in fact take into account the need for renovation and the capital needs so that you would have the resources to do that. And I don't see
included in this presentation. So there are some basic presumptions that the team has made in terms of capital needs as it pertains to the reserves that would be included in this refinancing. So I think hopefully as the presentation goes on, that will come out in terms of how did we determine what that amount is that we should request and use for this particular ask. I will also just indicate that, of course, for our debt, our properties that don't have debt, the assumption is we don't want to have debt on those properties. So the questions that you have asked in regards to wanting to understand more about what's happening in those properties, we will definitely follow up. But on its face, if the property didn't have debt, the team did not include that as a property that we would want to put debt on. And so I think that answers that question. The NOI question is another one that we have to parse out as we go through our entire scattered sites. The other element and layer is really property management and our oversight of scattered sites. That's something that as an agency, we are really focused in on trying to address. That has been a challenge for us over the years. And so how do you turn a unit quickly? How do you get in and inspect these units? How do we address all of the needs of the scattered sites is also an operational issue, as well as our tenants paying rent. How are we enforcing and providing resources to our tenants? So it definitely reflects a number of challenges around the scattered sites portfolio that I want to just be transparent about, that we have to and are internally addressing. And so as the team presents this proposal, please do speak about our strategy and what our estimate was for capital needs. That was informed by a combination of our asset management team, our real estate team, and our property management and maintenance team working together to create an estimate that would give us that cushion for the capital needs and repairs for our sites.
I would just like to observe that the scattered sites were what built this agency. And it was unheard of at the time the agency was created in housing authorities having scattered sites. And it was based on the principle of fair share and dispersal, so that people had opportunities, broader opportunities geographically in the county. And to me, I understand that they are a nightmare in administration and management, but I also think that it's one of the things that's still of great value. And I trust we're going to find a way to produce or reduce the, for want of a better phrase, nuisance value, the administrative disruption. And because I think sometimes a single property can be as troublesome as a multifamily property that we're working on just because of the geographic distance. It's 500 square mile territory. And, but I do think that is still something that sets us apart in many ways and fits into so many things historically in the county of value that I appreciate the effort that you're putting into analyzing this and maybe getting some of the burden that the agency has carried to get that reduced and still be able to provide the benefit of the scattered site concept, because I do think it's very important for a variety of reasons, and would hate to have us end up disposing of these and offering only multifamily structures to our families. So
I also
it's
add-
worth the effort, I'm convinced.
Thank you. I do think that it's worthy of pausing the mortgage finance team presentation to allow Zachary Marks, our Chief Real Estate Officer, to also provide some additional context, and then we'll turn it back over to mortgage finance.
For the record, Zachary Marks, Chief Real Estate Officer. I just wanted to add a little bit of context because Commissioner Simon raises an important historical context to these units that, in fact, it was a big part of what HOC was doing for several decades. Big part of how it was providing this manner of, as Executive Director Andrews mentioned, really family-focused housing. The core issue that has changed since then is that those properties, when HOC acquired them and renovated them, a core part of that strategy was that we were using low-income housing tax credits for most of them, and or state housing partnership funds. And the reality is that you cannot use low-income housing tax credits on these properties anymore. So that's a major hit to the business model of being able to continually reinvest in these properties. And obviously, when we were buying them originally, they were often either new because they were our share of MPDU purchases, or they were 10 years old, 15 years old at the time. And now we're at 30, 40 years on these assets. So one of the core pieces of context that's important here is that HOC lost one of the major and only tools it had beyond debt financing to be able to reinvest in these properties. So that's one piece. One of the reasons why some of the units don't have NOI is because there are, as Monty mentioned, there are all kinds of different regulatory environments on these assets. And so some of them were set at deeply affordable rents that cannot be exceeded. And so there is a decent chunk where it's because of where the AMIs are set on those units that they don't, even without debt, they basically don't provide any NOI. And then lastly, I just wanted to note about the economic vacancy part. That is also part of the issue, the challenge of managing this portfolio, both the economic vacancy piece and the how much is it going to take to renovate this portfolio. And it's the right question, and it's just a very challenging answer with this portfolio, because the reality is, in the same way that one of the challenges that the mortgage finance team had in financing these is that most of the time, for a bank to give you a loan, they ask for something as simple as an appraisal. It's impossible on these. You going around and getting 1,000 appraisals on these houses at the same time couldn't do it. So like even the debt financing success that this team is bringing, even that was challenged by the sheer diffuse nature of this portfolio. Well, it's the same thing when it comes to estimating what the cost of housing is. It's by the time you've done analysis for 600 of the units, you've moved on to the next 600, and your analysis of the 600 units is already going stale by a matter of years. At our best, we're probably able to renovate about 50 to 100 units a year. So these are so there are some really significant challenges, which is not to say that's that we should definitely do one thing or the other as a result. But I just wanted to make sure that like there's a lot that's changed as we've accumulated this really important but large portfolio that do bring significant challenges from everything from operations to finance to even being able to tell you like how much we think the overall portfolio needs for reinvestment, a reinvestment that the commission would have to make without the ability to use low-income housing tax credits. So that's going to be a part of the story going forward. Thanks.
Yes. Thank you.
Thank you, Zach. Jeremiah?
So as shown on the screen, the ones that are highlighted are what we call the core scattered sites. So VPC 1 and 2, scattered sites 2, MHLP 10, they contain senior debt and or HOC or county debt. As a balance, if you just go down a little bit, shows what leads up to the total 1,038 that we considered initially for financing. Next slide, please. So we have evaluated strategies, financing strategies for properties, and we've received indicative quotes from Berkadia, PNC Bank, and Jefferies Financial Group. Our analysis to determine that the structure that would be most advantageous for HOC, both financially and fiscally, was presented by Jefferies Financial Group. It was presented as a bond issuance of both taxable and tax-exempt debt for a 35-year term. Any changes to the structure would be updated when items brought before the full commission.
At this point, I'd just like to say, as Jeremiah just stated, we have working with our financial advisor, chosen Jefferies Financial for this, but I would like to state that we want to acknowledge the efforts that PNC has made over the last 6 years and helping us financially keep the scattered sites portfolio afloat. This is our decisions are by no means reflective of our appreciation for the work that they do for us. This was a very hard decision. The choices that caused us to go one way or the other were marginal, but we feel we've made the right choice for not just the financing of the portfolio, but the other things that HOC relies on the cash flow from the scattered site portfolio for. And so as we stated earlier, this has been a unique underwriting, trying to separate that's important for the financing and that's important for the agency. And so I just wanted to make that point for the record and acknowledge PNC's efforts.
Could I ask one question related to that? Is if there were a reason to remove one of these properties from this plan, would we be able to dispose of it and do that? If there were a loss due to fire, if there was just the amount of resources needed to maintain the property in an acceptable standard that we have established, would we be able to dispose of it?
The structure that we are working on with Jefferies would allow for the disposal. The challenge is Jack was as Zach, I keep putting him J there. The challenge, as Zach was alluding to, is one, identifying in advance which properties could be sold, couldn't be sold, why they would be sold. And we just haven't gotten that far in our analysis yet. But I can commit the mortgage finance team. Any questions that the commission may have related to any other aspect outside of mortgage finance to push this forward, we will pursue that. And that is one of the questions we try to answer.
It just occurred to me that it's a number of units and conceivably there would be some reason to dispose of one, and if they're all bundled together, whether we could take something out of the stream. And so thank you, I appreciate it.
It would appear to me from an operational and my perspective of the portfolio over my term here, it would appear to me that from an operational and management perspective, that some reduction in the scattered site portfolio would be good, just to be able to allow us to better manage and get some economies of scale moving forward in making the capital improvements. It's doing all the things you need to do when you own this many sites.
Monty, can you speak to, because I think the question is in terms of the model that you're recommending moving forward with Jeffries, if we would have flexibility if we need to go and make adjustments with regards to the number of properties, and what, if any, benefit would that, consequence would that be? Would it be we're doing a call, a bond call, or do we have the flexibilities with regards to this model that you're recommending, or this financial vehicle you're recommending?
Or could you swap other properties
Right.
in,
Right.
you know?
Yes, inside of the tax exempt bond rules, as far as this particular flexibility is concerned, is the concept of reasonable expectation. So yes, if we identify some properties ahead of time and then we have to switch to some other properties, there was a reasonable expectation that we were going to do a certain amount of capital improvements, certain amount of substitution. We don't have to be entirely precise about that in the first 3 years.
I mean, some of these units were 10, 20 years old when we bought them 30, 40 years ago. So that was what was motivating. There might be a time when the statistical life just doesn't hold up and merit what we're having to put into something, or any kind of a loss that might occur. So that's very reassuring to me. Not that I'm arguing that we dispose of any, because I think it's a very valuable part of the program. But thank you for that.
Well,
We keep interrupting you, I'm sorry, but this is a complex issue and an important one.
So essentially, we're looking to approve the permanent financing plan of the select scattered sites properties and approve the executive director to work with King Mitter to negotiate terms. Next page, please.
Speak up a little bit, please.
Sure.
These mics really need to be very close to your faces. Thank you.
apparently.
So this page shows how we looked at the 808 core units from an existing debt standpoint, which contributed 98% of the total debt among the 1,038, as well as we looked at the NOI as of March of this year for the purpose of sizing the debt. So as a part of the due diligence process, we're going to continue to work with the divisions that we've worked with, so budget office, finance, real estate, in order to adjust for any financial effects from COVID, et cetera, that need to be adjusted and normalize and size and structure the debt. We have discovered that VPC 1 and 2 specifically have contributed significant cash flow to HOC. We're sensitive to that, as well as keeping in mind all the financing challenges that Zach alluded to. So if you go to the next page, please. This is to show that we have looked at historicals of, this is an extract of VPC 1 and 2, going back to fiscal year 2018. This is a unique underwriting exercise. So we looked at income and expense above the line and below the line. And the whole goal of this exercise is to ensure that any financing is not going to have a negative adverse impact on HOC from a fiscal standpoint and a financial standpoint.
May I point out, just there is a typo in the date. You have the date is 2108, and I think you mean 2018.
Correct. It's not 2108
I
yet.
kept looking at that and then wondering why there was this big jump, and then I realized
We'll get that fixed.
what I was looking at. Thank
Yeah,
you.
it should read 2018 through
Yes.
present fiscal year. Next page, please. As Zach alluded to a number of challenges, but we have a few listed here. So the financing options are limited given the scattered nature among the county rather than a singular building. Additionally, it's cost prohibitive to obtain a comprehensive valuation or capital needs assessment among the portfolio. Real estate owned by HOC within the portfolio is not available to be used as collateral. So it resulted in other forms of collateral being needed, including pledges of revenues and potentially the general obligation of HOC. As mentioned, we received quotes from PNC Berkadia and from Jeffries. And on the next page, we'll show the initial comparative analysis. Next page, please. So these are the financing scenarios we received for initial analysis. After consulting with Kane Mitter, we eliminated Berkadia due to Berkadia looking for real estate as collateral, as well as requiring some third-party reports that were going to be cost prohibitive and not work with the timing that we needed to close by August of 2023.
Should we pause?
I think we should continue.
Sure. Once Berkadia was eliminated, we then looked at the PNC, Jeffries, and Jeffries 30 and Jeffries 35 year scenario. Ultimately decided or concluded with Kane Mitter their consultation that the 35-year amortizing taxable and tax exempt scenario was the most advantageous due to the amortization period, the annual debt service, and the potential of excess proceeds for the purposes that we're looking to cover, including capital needs expenses moving forward, and ultimately the fiscal impact to HOC. Next page, please.
Can I, this may be a dumb question, but I assume it's a package deal, like you've got the non-AMT and the taxable. Can't do like one from one and the other from different.
So you can't refinance existing tax exempt debt with non, well, you can't refinance essentially non-AMT with the taxable. So we had to break that.
I meant more like, could we do the non-AMT bonds with one lender and the taxable bonds with another? Like, I'm just looking at the different sort of debt service coverage ratios, or in the annual debt service. So it's not a huge difference between PNC and Jeffries on the taxable, but it's a little low, even though the amortization period is shorter for PNC. It's the rate is much lower. So the annual debt service is actually slightly lower on the taxable.
That's something we can consider. I mean, PNC and Jeffries, they are all part of our investment banking team. So that is a question I will run by Kane Mitter. See if we can, let me be sure your question is, can you do the tax exempt with one and the taxable with the other?
Right.
Yes, I can find that out.
Okay.
And I would say that I guess that's a good question. However, what we do need to have from the committee is clarity on what direction we'd want to go forward, or what the committee would support. And so if we didn't evaluate it in that way, then maybe we need to pause, get a quick answer to your question so that we can provide that information today, if it would inform how you would move forward. We looked at each of the proposals as a combined strategy and approach versus piecemeal. And so I think we might need to get that clarity for you so that we know what we're taking to the board in May.
Right.
Yes.
Right.
Okay.
Thank you.
Thanks.
So this slide shows the final scenario that we looked at, which was PNC's private placement issuance as compared to a general obligation bond public offering. And just want to point out, so these are PNC's assumptions that we have in front of us. The ultimate pros and cons that we derived were that for the PNC scenario, while they would not pledge HOC's GO, these deals were very close. And ultimately, while pledging the GO was required for the public offering, the greater optionality, no minimum debt service requirement, no debt service reserve requirement, additional bonds test on the full call option in 9 to 10 years were proven to be beneficial to HOC in ways that we were able to determine that this would be the most advantageous. On the PNC private placement, there was a higher cost of issuance, a bond defeasance requirement, and a non-competition covenant, as well as the bonds could not be called for the full 25-year amortization period. Next page, please. So estimated sources and uses at this point in the 35-year Jeffries taxable tax exempt scenario. So we do show a funding gap at the moment. Should say that is assuming that we pay off all existing debt that was shown earlier in the presentation for the 1,038 units. By the time that we get to closing, this would have amortized further down, and interest rates will have to account for adjustments. But there are some options that we do have to cover the gap if we determine at the time that there is one. But again, this assumes paying off all the debt. And additionally, we assume the 1.45 debt service coverage ratio as to not negatively impact HOC's Moody's rating. And ultimately, we would work with Kane Meder to refine our assumptions and continue to essentially determine the breakdown between taxable versus tax exempt proceeds, as well as we'll continue to lead the conversations that we've been having with real estate, property management, and asset management to appropriately and sufficiently size the debt for all the capital needs of the portfolio. Next page, please. Issues for consideration. So does the Development and Finance Committee wish to join staff's recommendation to the Commission to approve the financing plan of select scattered sites and approve the Executive Director to work with the emitter to negotiate terms? There is no adverse impacts anticipated on the FY 2024 budget. We'll continue to work with the Budget Office to determine the accounting and mechanics of the scattered sites cash flow to HOC and the cost of issuance, the cost associated with closing and paid from cost of issuance budget. So again, staff recommends that the Development and Finance Committee join in the recommendation of the Commission and recommending that the Commission approve the permanent financing plan of the select scattered sites and approve the Executive Director to work with Kane Meder to negotiate terms. I just wanted to lastly thank all of the divisions for their help up to this point, especially Gio, who was instrumental in this process. So we look forward to continuing to work with all the divisions on this very important transaction for the agency.
Unless I missed it, I think Director Andrews was suggesting that you were going to talk a little bit about how we were going to deal with the rehab and or what do we have in replacement reserves currently?
Didn't they send us a sheet?
No.
No.
So currently we are we're setting aside about $547 per unit in reserves. How to appropriately size it. Those are going to be ongoing conversations with the divisions. As has been alluded to, the portfolio has significant needs. And as of right now, it's an ongoing process. So we will, we'll seek to figure out what the appropriate amount is set aside for this future debt sizing will be, but ultimately, what needs to be done in the next 3 to 5 years is going to be a collaborative effort of conversations that have begun.
So we will have a reserve schedule and plans specifically per property.
So what currently, Commissioner Nelson and Commissioner Simon, we have set a ceiling to our debt sizing of 60 million, which takes care of the 47 million for PNC. And as Jeremiah alluded to, remaining debt that both HOC and the county have as it relates to the portfolio. The difference of approximately 8 or 9 million, those are, we haven't yet identified how those proceeds are going to be used. Those proceeds we assume will be taxable. The taxable proceeds have more flexibility in terms of how you can use them in the portfolio. So we really have to refine, get the answer to Commissioner Berkowitz's question, which I've requested, and refine how we want to use the use of proceeds. And that's, as Jeremiah says, what we're working with the other divisions to do.
Let me, related to that, you go back to page 16 or slide 5. It shows you've got, okay, 52 million in senior debt. What about the 7 million in other debt? Is that anticipated to be covered? How's that going to be covered?
So in the sources and uses
Pardon me?
so in the sources and uses that we showed on that final table, so page 12, we are seeking to pay off that debt. That's included in that $58 million number.
But you just said you had $8 million. That we were talking about 52 million of the 60 million in retired debt, but this anticipates using 58 million. So there isn't 8 million left. I'm not trying to be argumentative. I'm just trying to understand. And it all goes back to my original question, and I think Jackie's. One, I consider the scattered site a significant and valuable inventory for HOC. And I'm just trying to figure out how we are going to, in fact, successfully deal with it. And I'm bothered by the fact that I don't see how we have the funds to pay for the rehab that will, in fact, be necessary. And $500 a month or a year isn't going to do anything toward that. So that's a major question. And while I'm talking sort of with knowledge, one of the other questions that I had, and I know this is treading on dangerous ground, in terms of fees, you mentioned that we can't use LIHTC. And if you go back to slide 8, page 19, development court fees. Development court fees essentially come to HOC. Some portion goes to the OHRF and some portion goes to.
The DevCo fees are really just cash flow being swept to the general fund. So none of that goes to the OHRF.
Well, okay. Then because we have the significant issue that we have with scattered sites, has any consideration been given to, or should we give consideration to targeting these DevCorp fees to those scattered site units, as opposed to dumping them in general fund? And I mean, it's not overly significant when you think about the total amount in the general fund. And we are in serious trouble in terms of trying to find out how to finance this whole scattered site package.
There's a couple of additional points that I think would also provide some context. One, we have approximately $4 million, and I would hope the team can share more details in regards to what that specific number is that was put in reserves with the PNC financial model that we currently have that would be released as we pay back that loan. So there's $4 million that we had to hold in reserves that we would take then to put towards our scattered sites improvements. We also have approximately $3 million that the county provides to help for repairs for our scattered sites. So we have about $7 million of resources that we can contribute towards capital improvements that also would be a part of our strategy. And then Zach, I'm not certain if you have any additional information you'd like to share in regards to how we planned out the improvements needed.
Yeah, so I mean, it is the core question. I mean, what we're solving today is really the issue of the outstanding debt indebtedness on the properties. The issue of future capital investment need for these properties is another significant issue to this portfolio. So you've got some of the monies that Executive Director Andrews just identified. There's a few $1 million. I think it's like $3 to 4 million in replacement reserves as well. But the reality is that again, as we move through this portfolio, these are units that are typically requiring a significant amount of reinvestment when they get to that, that 40 year mark. So this financing is really just, for the most part, solving the outstanding indebtedness issue. One way to think about these DevCore fees, they really are being used here. And so the way to think about it is, if you go to slide, it's 8, kind of look down in the below the net, in the below the line, there's a few rows there. Below net operating income on the left side, you'll see it's kind of they're grouped together in a below the line grouping, where you have capital expenses, debt service reserve, contribution, DevCore fees, as Commissioner Nelson highlighted, and debt service. So right now, the actual debt service with these things sitting on the current PNC financing that's expiring is if we go all the way over and just use the right column just for the sake of this conversation, our NOI is about 4.6 million. The actual debt service is about 2.3 million. That's that 2336212. And so the net cash flow from these properties is really going toward the 376, which is going into the reserves as a deposit. And really the free cash flow is the 2.8 million, which is the 1.385645 and the 1.438288 being combined. What's effectively happening is that's cash flow that is now being effectively used to support this new financing. Now we still have a residual net cash flow after the new financing. We have the 4.6 million NOI and now we're at about 3 million in debt service. So you still have about 1.4 million in cash flow coming to the agency after debt service. But basically what's happened is some of that, the debt service has gone from the 2.3 to the 3. So about 700,000 of that cash flow that's in those other two line items is now getting tucked into this future debt service number. So the thing that we're trying to balance here that all these different divisions are trying to balance is we have the budget office saying that the commission relies on continued cash flow coming from these properties. So we're balancing the fact that mortgage finance needs to solve the issue of this expiring indebtedness. And then the rest of us, our part of the contribution is really talking about how are we going to be able to pay for renovation on the properties going forward forever, because it's never going to end. By the time you get through 1,800 units, it's time to start over. So it really is there is a big question mark, because what you would have had with the LIHTC credits is the ability to get 30 cents on the dollar of that hard cost need, and that's gone. So whatever the hard cost is, we would have had 30% of that as a resource, and so that's gone. And so part of the issue with describing what is the overall need for the property is, by the time we get everybody through the whole property, or through the whole 1,800 units, the old numbers are bad, right? So it's really just saying what we've seen historically is that an average for these units is 75 to 100,000 a unit in renovation. So we know that the VPC's got significant comprehensive renovation.
Since the county has particularly set aside or designated some resources to us for these units that are particularly heavily subsidized from the point of view, I won't use the word assume, but would another possibility be to ask the county to increase the contribution toward maintaining these units? If I'm not mistaken, these are some of our largest units on bedroom counts and serve our larger families. And there was a decade in this county when not a single 3-bedroom building permit was issued, an entire decade. So, and we're still very short 3-bedroom and larger units. So that's the other reason to me, these are so precious as a resource. So, and I would think that the county would agree that this is a precious resource and would at least actively consider.
We definitely can pursue that in terms of asking for additional support. First thing we have to do is make sure we fully utilize what they've allocated.
Yep.
And so that's also us corralling around getting to each of these sites, getting the repairs done, the procurements needed to get everything done in a order that allows us to use the resources that they have allocated and demonstrate the need for more. And so a part of our strategy should be asking the county for support as we move forward, and also thinking about how we intend to support. I know that this is a good discussion, but just for time check, do want to indicate that there are a couple of other agenda items for today, and we have commissioners on standby to join a special board meeting in 15 minutes. Obviously, as time permits, we can make modifications, but I just want to make sure I raise that as well.
I get, coming back to my question, your object,
Sure.
asked just about whether it was possible to split the taxable and non-taxable bond issuances. And I mean, some of what I'm looking at, I'm trying to understand what the factors were in terms of the recommendation. And, I do recognize, so, with Jeffries, it's, we're getting as a package, at least, it's a larger bond issuance, which, gets, I think, to the discussion we were just having about making sure we've got enough capital for renovations. So, maybe my question is moot if we need all of that and we need an additional issuance if we went with PNC as a package. Though, is it all about the bond issuance? Is it about the debt service coverage ratio? How much does the lower amortization period of PNC factor in? So, for example, with the non-AMT bond issuance, it is a higher debt service coverage ratio, but we'd be building up capital or principal, at a much quicker rate. And so I was wondering about how that trade-off was thought about.
All of the issues that you raised were part of the measurement. If I could start at the macro level with the biggest consideration being the risk to our GO bond. The fact that I'm working with our financial advisor who has worked with the agency to issue hundreds of millions of dollars of bonds and understands the risk to our indenture probably better than anyone. And the flexibilities afforded by the ability to issue tax taxable debt versus tax exempt,
Mhm.
made it more attractive to me. As I was stating earlier, this is a unique financing, and so we have to think just beyond the term of the financing in this case, and think what's best for the agency and the scattered sites portfolio. And it's just a perpetual constant change in what's going to be needed. We don't know. We just don't have any idea what the economic situation, but we could have another COVID, but we do want to be able to maintain the flexibility to just move properties around, to be able to raise capital when we need to, and that seems to work best with the Jeffries execution in our opinion.
As a package, or does that matter like between the taxable and the non-taxable? Or is that only within the taxable?
As we considered it as a package, but as I said, I will go back and I've already questioned them.
Okay.
And I, as I stated earlier, I acknowledge the PNC role in this, so this was a difficult decision for us.
So what?
I just one last one. I know we're pressed for time. Commissioner Nelson was asking about the reserves. I just wanted to give him a sense that the initial facility that PNC created started a reserve fund at $1,200 a unit and a debt service reserve fund. It's built up to about 4.186 at the moment. It has not been included, as Executive Director Andrews stated in our stack, but it is something that we plan on figuring out where it fits. We didn't want to be so presumptive as to just insert it without understanding exactly what the mechanics of how that money could be taken and used was.
And I guess considering the fact that we're about to consider and present to the full commission a budget for FY24, there's a possibility that some of this can be addressed in that budget, meaning the rehab. I mean, I think back, if I'm not mistaken, on VPC 1 and 2, there was a 2 or 3 year plan to rehab those. And we've gone through that plan, but we don't have a plan now for this. I mean, that sort of suggests that what is required is that we in fact do begin to develop that rehab plan for them and start putting the money in before it somehow gets needed and used for some other purpose. And I just, the two things are coming together at the same time. So I'm concerned and want to ensure that we do address that in 24.
Thank you, Commissioner Nelson. We will definitely go back, look at how we have currently allocated resources towards these improvements, and then also think about timeline. We just brought on a new staff person who's doing unit by unit inspections and evaluations at each of the scattered sites. So we are getting out there so that we can understand what that need is. Of course, we're coming off of COVID, and so there's so many areas that need to be addressed, including just maintenance issues. And so we will, when we present the capital budget and discussion for the BF&A, have more perspective on where and how we see movement in FY24 versus 25, because there's a lot of ramping up staffing and otherwise that's happening here before we'll be able to commit all of the resources towards the capital improvement. So it might be tail end of 24 going into 25 before we see some of those come into fruition, but we'll definitely circle back and address.
Given this information, is there a motion?
Well, that's, I guess what I'm trying to understand. Like, so if we want to do some additional research, is this time sensitive? I mean,
there is some time sensitivity because it's, and I should allow the director to respond, Director of Mortgage Finance, but my understanding is that we do need to be teed up to move forward with a public offering by June in order to be situated by August. And so the thought was that we would go before the board in May. That would give us some flexibility if there are questions or concerns, but we ultimately need no later than a June approval by the board in regards to our financing to be in alignment with an August delivery of bonds. And so, or late July.
So I guess my question is then, are we comfortable holding off on this until we get some additional information? Or the alternative for me is like, I guess I would be comfortable forwarding it to the board for my own sake, not necessarily with recommendation at this point, but if we got that additional.
Between now and the board meeting for us to answer the questions that were raised by the committee. Absolutely.
And if the new information changes staff recommendation, that would be okay with me.
I hope to have the answer to your question today or Monday.
Okay. Yeah, and just like I said, understanding that trade-off between the lower annual payments and the amortization, and and also understanding, on the taxable side, if there's additional flexibilities that gives us, and with the higher bond issuance, I mean, it seems like on the non-taxable, the bond issuance is the same, and so there it's really just a question of annual payment versus, lower rate and lower amortization period.
Could we table this to a time certain meeting that we would schedule prior to the commission meeting, perhaps even immediately before the next meeting before the commission meeting, so that we could take the action and move it forward to the full commission at its May meeting?
The committee at this point can make whatever recommendation you want. So to Commissioner Merkowitz's point, you can make the recommendation with questions answered by the commission meeting. So.
Okay. Would you be comfortable making such a motion?
Would this be a recommendation to support the staff?
You could change it.
Well, I guess my motion would be to forward the materials to the full board without recommendation at this time, but with the anticipation of receiving additional information prior to that board meeting and presented at the board meeting as well. With a staff recommendation.
How would you respond?
So then you're essentially saying that we would go to the board with no recommendation, and the final disposition would be at the board meeting.
Yeah.
Okay, so it would not call for another reconvening of this committee.
Unless you
No.
you all want one.
I'm fine with
staff.
having that. I think he just got a plan for maybe a little bit of discussion at the full commission meeting. Because there have clearly been a few issues raised here that are worthy of consideration and understanding, at least, by the full commission. So I would support that.
All right.
So second.
It's been moved and seconded. All in favor indicate by saying aye.
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 Thank you.
A big issue, valuable resource. Gotta do the work to get the benefit. Thank you. Now, how do we proceed given the time with commissioners? How would you advise?
Well, commissioners, there are two matters, I believe, that are remaining. Hopefully we can address your questions swiftly and also notify other commissioners that are on standby that this meeting is running a few minutes.
To avoid that, could we reconvene the committee?
One of the matters is the a matter that needs to go to
Yeah.
the special
About to say.
Oh,
session. That's why. So I guess I would just ask our mortgage finance team, or maybe I can just present the recommendation for moving forward with the issuance of single family mortgage revenue bonds. The presentation was provided in advance, is extremely thorough and is normal practice for our agency so that we could provide this resource. I would ask if you go to slide 36 that you see in summary, page 36, I apologize, thank you. In summary, what the request is for support of this committee that's approving the structure and issuance of a 2023 bonds under our 1979 mortgage revenue bond resolution in an amount not to exceed 40 million in aggregate, and approval to allocate up to 15 million of private equity activity volume cap to complete the transaction herein proposed. Approval of the cost of issuance budget estimated to be approximately 530,000 and not to exceed 610,000 to be funded by available funds from the single family program, and adoption of one or more series resolutions authorizing the issuance of the 2023 bonds. And I'd like to pause and ask if there are any reservations or questions related to that request.
I would move that we support the staff recommendation.
I'll second.
it's been moved and seconded. All in favor indicate by saying aye.
Aye.
Say,
It's it's approved. Thank you.
Thank you. Commissioners, this next matter relates to our headquarters. And you've received some presentation on one aspect related to the general contractor. We have a special session with the full board coming here momentarily. We could do one of two things. We can provide you with this presentation now, or we could request your support to advance this to the special board session and provide the recommendation and the full presentation to the full
And
board.
just go through one presentation.
Yes.
Is that acceptable to my colleagues?
sure.
I think that probably is
Good
the best
solution.
way to do that
Thank you.
and the most efficient.
Council.
So,
Thank you. And so then,
do we need a motion to,
You can say, you can table the item, or you can say that you're gonna forego the presentation and not make a recommendation, and instead hear the presentation in the special session. And then if the commissioners ask at the special session.
rather than tabling, I would move that we forward this item to the full commission without recommendation so that we can all hear the presentation simultaneously.
Yes. A second?
Second, yes, thank you.
It's been moved and seconded that we will move this item to the special session and hear the recommendation of the staff. Our colleagues will also benefit from the presentation of the staff. All in favor indicate by saying aye.
Aye.
Aye. We're done.
thank you.